Well, good morning, everybody. Thank you so much for joining us today for the A&I Financial Tax Tips for 2021. I'm Karl Frank. With me, I've got Mike Miller, CPA. We're going to have a great conversation today. Just a few rules for our Zoom. We are recording this, so to keep everybody's privacy, please keep your video turned off. And we entered everybody into our conversation on mute. We will have questions at the end, so at that point in time, it'd be a great time to take yourself off mute and to turn on your camera when we get to the end of today's presentation. Mike and I think we'll probably go about a half an hour, and we'll cover what mostly is actually good news, so that, lighten the tone right at the beginning. We are talking about taxes. We're not talking about death, the only two things that are assured in the world. And it doesn't look like taxes are going to be a whole lot worse for next year. All right, so Mike, if you could flip it forward, this is our disclosure. Please talk to your CPA and your financial planner. It's pretty important that this is not tax advice. Okay, next slide. Thanks, buddy. And then I want to remind you that we've got an expert team. So Mike and I are part of an expert network team. These four professionals whose names you see at the bottom of the screen here, we volunteer our time with each other. So clients of A&I Financial Services and clients of Miller and Associates get the advice from all four of the members of the expert team free of charge. They get the free initial advice. If you want to engage with one of us after that, we give you the family discount. The members of the team are myself, Karl Frank, CFP with Certified Financial Planner with A&I Financial, Mike Miller, CPA. I'm going to tell you more about Mike here in a second. Jeff Cromendike, an insurance expert with Securities First Insurance Agency. And the fourth member of our team is Nathan Merrill, an attorney with Good Speed and Merrill. All right, well, our speaker today, I will be Mike's wingman. Mike will be doing most of the presentation. He is our expert. Mike is a CPA. He's the founder of Miller & Associates. He founded that in 2011. Mike's team provides accounting, bookkeeping, business advisory, personal finance management, tax preparation services. His expertise is taking complex situations and breaking them down into small, manageable, easy to understand pieces to help eliminate confusion and frustration. 100% of the staff is certified as a QuickBook Online Pro Advisor. Mike started his career in 1988 with Coopers & Lybrand. He holds a certified professional accountant CPA designation and a Bachelor of Science in Accounting from Colorado State University. One of my favorite stories about Mike is he played football in college. So if you don't have any other questions at the end of today's presentation, we can ask him about trying to tackle one of the all-time great running backs who ever played, Herschel Walker. All right, so without further ado, Mike, the floor is yours. Thank you for teaching us about the tax tips for 2021.
Thanks, Karl. To clarify, it was Junior Athletic Association football when we got Herschel Walker and his team. So it wasn't college. There's no chance in that one. Welcome everyone today. Thanks for joining us. Go over some tax information for the upcoming year. It should take about 20-30 minutes. Then we can open the floor up for questions. I think we've got some pre-submitted questions already that we can go over. But right now, let's just cover some of the basics and the ground rules. All right, there we go. So the Build Back Better tax plan. Wow, from where it started to where it is now is drastically different, to say the least. Right? We were hearing, capital gains in excess of $1 million would be taxed at ordinary income tax rates. We were saying they're doing away with the Roths, the backdoor Roths, all these weird, retroactive adjustments. And I didn't want to speculate too much on it because I thought that was a little too far-fetched. I sort of had a decent feel for what the congressional status was on all this. And a lot of it's gone away, thank goodness. So a lot of it's just noise that's just not out there anymore. That being said, who knows, when they get into session, they want to change some stuff around, they can do a lot of different things. But for now, I'm pretty sure that cooler minds have prevailed and a lot of those wacko things aren't going to happen. They are talking about increasing on the itemized deduction schedule, what we call the SALT increase. So it's capped at 10,000. So your state income taxes, your general sales tax, your property taxes, personal property taxes, and your real estate taxes were capped at $10,000. Now, depending on what state you live in, maybe that's not as bad as some other states, but imagine if you live in California or New York or Philadelphia or Pennsylvania or something like that, where the state income tax rates are really high, and you're paying, $60,000-$70,000 just in state income tax. You can now, you're capped at $10,000. So the proposal is, and it sounds like it's got traction, that will change to 80,000 for 2022. Actually 2021, sorry, retroactive adjustment, which would be great. The child tax credits are still going to be in play as they were effective about 6 months ago when they changed the law. Children under 5 get a tax credit for up to $3,600, up from $2,000. There is scuttle that they want to make that permanent going forward. Don't have a feel for the traction on that just yet. Children age 6 to 17, it's a credit of $3,000, up from $2,000. And there are a little bit of income limits on that. Dancing around here. Sorry about that. Now, there are income limits on when you qualify for the child tax credits, and I believe it's head of household was 117, and married filing joint was 150 for the child tax credits. So be aware of that. They do phase out after a certain period of time, but for those of you that qualify, it's a nice little kicker in the form of a tax credit. The long-term capital gains, there is traction to raise that from 20 to 25% for the higher income people. So just be aware of that. I don't have a real strong feel one way or another, but it's starting to tend towards yes, they're going to do that. Let's hope they don't.
Wait, yeah, you wouldn't want to punish anybody for being successful, right?
Yeah.
That does look like it's going to go through.
I'm hoping it doesn't. There's enough. They've talked about enough pain and punishment. We need to just go back and focus on all the money we're spending and how we're going to get that back.
Right.
Digital currency trades. That's pretty much a hot topic, and everyone's agreeing that needs to be reported differently. So there will be some changes to that. Right now, the IRS really doesn't have any insight into a lot of the crypto and those kind of currency exchanges and the valuation, and they're treated kind of a lot like stocks, right? You buy a stock for $10, sell it for 20, you pay gains on $10. It's the same thing with the digital currency. You're getting it at a certain price. The only difference is you're transacting either in trades of cryptocurrency or you're using the cryptocurrency to buy something. And so if you buy something and you bought $1,000 in cryptocurrency, you bought something for $5,000 because that 1,000 appreciated to 5,000. Technically, you have to pay tax on the 4,000, right? But there's no real strong mechanism for that to be reported to the IRS. But I think they've come up with a solution where they're going to impose 1099 reporting on the cryptocurrency custodians. So that's going to happen. I heard it was 20,000 when the IRS did like an initial request, and it wasn't tax law. I believe they were talking about $600 initially. Now they're talking about $10,000. So they're still kind of dancing around. Not sure where that's going to land, but there certainly will be some digital currency reporting requirements for 2021 and going forward. For business owners operating as pass-through entities, so if you're a sole proprietor or Schedule C operator, small business owner, or an S corporation or a partnership, one of the things they're talking about is imposing the 3.8% net investment income tax to trade or business income in excess of $400,000. That seems to have traction, so be aware that could be a hit that we're looking to incur for this year. I got my fingers crossed that cooler heads will prevail. That's income we've earned through the operation of a business and not investment income that we've created by investing in something that's appreciated. So, I mean, our hard-earned money should not be subject to the 3.8 tax. It's kind of my opinion. I hope cooler heads will prevail. If your income's less than 10 million, everything pretty much outside of what we just talked about is going to stay about the same. So not a lot of big changes there.
So that's certainly a lot less painful than what they were talking about before, but still, I mean, if you're running a small business and you had, 400,000 of profits, you're now going to pay, another 3.8% on those profits.
Right. Yeah. And that's, $3,800 on 100 grand.
That adds up.
It's up, yeah. It's and it's our money. It's the money we worked hard to get. So we'll see. Hopefully it doesn't go through.
It's a disincentive for small business owners.
Yeah, for sure. Standard deduction increase for 2022, yeah, is going up from 12,550 to 12,550 up to 12,950 for the single and married filing joint. Sorry,
so that's good.
Single folks
it's reversed.
We've got married filing joint on there. That shouldn't be there. Married filing joint's going up from 25.1 to 25.9, and then a head of households going up 18.8 to 19.4. So kind of typical what you normally see type increases in standard deduction for what they're deeming to be inflation. However,
Right.
that's a different story. We don't know what inflation is going to do quite yet, but it doesn't look good.
Well, it sure is getting higher, isn't it? But the deductions are great. And a lot of people, more than ever, what is the number? I mean, some big percentage of people are filing just the standard deduction, bigger than ever before.
Yeah, it was 70, 78, 79%. It was a pretty big number.
Big.
Yep. There's still no personal exemptions. I know everyone was kind of used to those in 2017 and prior. So those are still not out there. They're still going to be they're still going to not be in play at least through 2023. There's no limitation on the itemized deductions. In the past, they used to limit it by 3%. They don't do that anymore. It's still that way now. The earned income tax credit's gone up a couple $100 from 67.28 to 69.35. HSA contributions still at 36.50 for a single person, 7,300 for a married couple filing joint. There is the $1,000 catch up for individuals over the age of 50. The gift tax exclusion has gone up from 15,000 to 16,000, so another grand.
So those are some big planning items there. Yeah, you can give away 16,000 without having to file that gift tax return in 2022. So that's big news. That's exciting.
Yeah, and to clarify for those of you out there that don't understand the gift tax, you each have 11 million something. Nate could speak to this better than I can because he's the estate planning attorney, but you all have an estate plan exemption amount of like 11 million per person. So a married couple filing joint has an exemption of $22 million. So if you gift money to somebody in excess of what would be the limit of say 15,000 in 2021, you have to report a gift tax. You have to file a gift tax return for the excess above $15,000. But that doesn't mean you're paying tax on the excess that you donated or gave away or gave to somebody in the form of a gift. It's not a donation, it's a gift. The excess, say for example, you gave Karl $50,000. Gift to Karl. Here you go, Karl. Thank you very much. So 15,000.
That was a great seminar, man. The best I've ever been to.
15,000 of that's really not reportable at this point in time, but you have to file a gift tax for the additional 35. And so what does the 35 do? You're not paying gift tax on the 35. You're just reducing that exemption amount, which would either be 11 for a single person or 22 million for a married filing joint couple. You're reducing that gift tax or the estate tax exemption by the $35,000. No taxes are due. It's just a mathematical calculation that they do at the IRS, and they track by the form of those gift tax returns. It would impact your estate tax return at some point if your estate reached the limit of that 11 or $22 million mark. So just FYI on that one. A lot of people get confused, think they have to pay gift tax on any gift in excess of the limit, but that's not true. Just have to file the return and report it to the IRS.
I think that's a really common question. Thanks, Mike.
Okay. 401ks, all your deferred accounts, they've gone up from 19,500 to 20,500. Still, the additional catch up if you're over the age of 50 is still $6,500. So you can put 27 grand into a 401k. That's not bad. The simple plan went up to 14,000. The maximum income requirements for IRA contributions, the IRA contributions stayed the same. They haven't changed. 6,000 with a $1,000 catch-up. The income limits for those, if you don't participate in a plan with your employer, for single and head of household is up to 129,000, and it phases out at 144,000. So if you're at $135,000 in income and you're a single person, you might get $5,400, into an IRA, but you don't get the full amount to contribute in. Married filing joint up to 198 with a phase out at 214. So those limits have gone up, $2,000 and $6,000 each, respectively, for married filing joint couples.
Hey, a little bit helps.
Every bit helps, absolutely. The medical expense floor plan was made permanent at 7.5% of AGI. Not sure if that's a red dot, a yellow dot, but 7.5% of adjusted gross income sometimes tends to be a really big number. And when you're covered by a health insurance plan, you're almost never going to make 7.5% out-of-pocket expenses.
Yeah, that's a hard one because it can be just a huge expense for an individual to even hit that, and that might be an end-of-life situation. So it's really not a helpful for most of us. Not all that helpful.
Yeah. But that was made permanent. It was 10. They were dancing around between 7.5% and 10%. Now it's just 7.5% going forward, which is kind of nice.
Better than 10.
Better than 10. Charitable contributions for non-itemizers. So if you don't itemize on your tax return and you make a charitable contribution in 2021 of cash to a nonprofit organization of at least $600, you'll get another above the line deduction of $600 to match that on your tax return. Not a ton of money, but it's there and it's available. $600 at 30%, $180. So it's all worth it.
I think it's worth it to make that extra check at Christmas time, right? Because every dollar you give is an above the line deduction, which is a really good deduction to get.
And it's not for non-cash, right? So you can't go to Goodwill and get it that way. You have to get a cash contribution.
You have to give cash.
Yep, have to give cash.
Yeah.
Don't forget to get that receipt.
Give cash.
I get this a lot when I file tax returns and I'm looking over the client's documentations, the GoFundMe, gifts that are made to different situations out there. The GoFundMe money that you allow out is not charitable deductible, right? It's not a charity. You're not giving to a nonprofit organization. You're giving to a person or an event, and these are gifts, so you can't really deduct those. Marginal rates for 2022 are going up. I think everyone can probably read through that without me having to explain it to them, but the tax bracket didn't go up to 39.6 as they were projecting. It stayed, I think it went up a point from 36 to 37. Everything else, pretty much from a percentage standpoint, stayed status quo. And just the income amounts when you move from bracket to bracket went up a little bit for inflationary purposes.
So this is good news because it was really scary for a little bit and it was super confusing. And I'm so glad that they didn't actually decide to change the marginal income tax rates because that's, taxes are the biggest cost we pay in America.
Right. Agree. And I still don't like that there's 1, 2, 3, 4, 5, 6, 7 different bands. They could narrow that down to like 4, pretty
seriously
easily and get the same effect.
Right.
I guess
Mike, I thought you would like it. It keeps you employed, right? Makes it so confusing. We have to have a CPA do it for us.
I don't focus so much on the marginal rates, Karl, as I do the effective tax rates. The effective tax rate is basically how much tax did you pay divided by your taxable income. And while you may think you're in like a 24% tax bracket, maybe your taxable income points you in that bracket, but maybe you're at 18% effective tax rate, right?
That just seems a lot less painful.
Yeah. So I look at when people say, what's it gonna do to my taxes? I look at it more from how much more are you gonna pay as a percentage rather than is it gonna kick me into another bracket? I think that's more valuable.
Right. That makes sense.
So some year-end tax strategies for your stock portfolios. Karl, chime in anywhere you see fit. Tax harvesting. Karl's doing that all the time, right? Sell the
We
losses?
are, and we did some of that earlier this year. But for a lot of our clients who may be on the phone, talk to your financial planner because we don't have a lot of losers. So the tax harvesting, I mean, it's been a really interesting year in that it's really good. So, we're going to have to maybe pay a little taxes on those taxable accounts. But talk to your financial planner to find out if you're in that situation.
And possibly talk to your tax preparer, your tax planner, because you'll have incremental tax that'll be due on that won't be covered to any withholdings that you may have made.
Right. You don't want to pay a penalty.
Right. With capital gains and losses, you have to report all your capital gains, but you're limited when you get a capital loss to $3,000, and you have to carry forward the rest. So be sure that if you are taking some losses, that you at least try to get that $3,000 deduction to offset some of your ordinary income. Not much, but $3,000. Avoid the wash sale rules. Don't buy and reacquire stock within 30 days of the sale, because then it disallows the new basis portion when you're paying gain on it. You basically defer that basis till later. Karl, I don't see a lot.
Yeah, and we do that for our clients. Yeah, we do that for our clients. So if we're going to tax harvest for folks, we make sure we obey all those rules. And again, if you've had losses that you've carried forward at that 3,000, right, we've probably used them up because we've had some pretty good years lately. But if you still have one, that's great. I love that $3,000 deduction, even though it's so small. And that's a hidden tax increase, because I don't remember what year that was. Mike, do you remember what year they put in $3,000?
It's been a while.
A long time ago, right? Yeah, right. And $3,000 back then, and this has to be 30 years ago, was worth a lot more than $3,000 today. So in some ways, that's like a hidden tax increase not to index that
right.
Loss carry forward for
right.
inflation.
Yep. Gift appreciated stock to the parents and the non-kitty tax children. So, kind of your grown children that maybe are in a lower tax bracket. It's a good way to not have to pay taxes on some stock. Donate appreciated stock to charity. You get to deduct the fair market value of the stock. You don't pay any tax on the gain. There is a 30% adjusted gross income limitation, so you can't take more than 30% of your adjusted gross income as a deduction on your charitable deduction page on the itemized deduction list. Don't donate lost sales stocks. You lose the deduction, right? So it doesn't make sense. Take the deduction and then maybe donate the proceeds rather than just give it away. Kind of a maybe an end of life thought, but don't pass away with large capital loss carryovers. They disappear. You don't get to carry those over, nobody else gets them.
Yeah, that's such a good point, actually, and we never think about that. But if you or someone you love is in that last stage, consider talking to your financial planner about any of the holdings they might have with losses, because you do have to file an income tax return the last year that you're alive. How you do that from the grave, I don't know, but you might want to talk to the person that's going to help you do it and use up some of those taxes to reduce the tax burden that the person inheriting your estate would otherwise have to pay.
Right. Some tips for the business owners, just to make sure you're maximizing all your deductions. Maximize the SEP contributions. SEP contributions for sole proprietors and Schedule C filers, LLC members, is limited to 25%, 20%, of the business profits adjusted for your self-employment tax. Whereas the S corporations and the C corporations, you get bigger deductions through those 401k plans. You can, if you use the solo 401k plan as opposed to the SEP contribution, the SEP contribution is limited either to a percentage of profit or percentage of wages that you've paid yourself. In a solo 401k plan, you can actually defer in 2020, 2021, $19,500 off of your paychecks throughout the year. And then the business can also make a matching contribution equivalent to 25% of the wages you paid yourself for the year. And that second payment doesn't have to be made up until the point in time where you file a business tax return. So you have a little flexibility between the end of the year and when you file that return to accumulate that cash and make that contribution in that 401k plan and take the deduction for the current tax year you're working in. So the maximum on that, I believe, was 58,000 for 2021. I'm not sure what it went up to, or if it's gone up for 2022, but
I bet it went up by at least that $1,000 that you talked about before.
Yeah,
we'll have to double check
the index. Yep. So again, if you pay yourself $100,000 in wages, right? You can put and you're an S corp owner, right? You can put $25,000 into a SEP, or you can put 25,000 plus another 19.5 into a plan. And the nice thing about that is, in addition to the 401k plan, you can split that in between what's called a Roth 401k and a traditional 401k. So you can actually defer during the year via payroll withholdings. You could defer $19,500 into a Roth plan. And then at the end of the year, when you do your matching contribution or your traditional contribution, it goes into the traditional IRA plan. So from a Roth component perspective, $19,500, and then add in potentially a $6,500 catch up if you're over the age of 50, that's $27,000 into a Roth plan in a year. Whereas if you're just contributing $6,000 outside of a 401k plan, that's a $21,000 lost opportunity to a Roth plan. Karl, I'm sure that makes you happy.
Great tax tips, Mike. I absolutely love it. You stated it so well. And that's exactly what I think a lot of people want to start talking about if we start worrying about future tax rates being higher than they are today.
Yep. So on the 401k side, if you do the Roth contributions, obviously those aren't deductible as the way that the traditional 401k contributions are. It's still an after-tax contribution, right? But wow, up to $27,000 if you're over the age of 50, putting that into a Roth plan. That's really pretty powerful.
That's a lot more than the $6,000 you can put in right now.
Right, and if you're within the income limits, right? If you're within the income limits, you can't make a contribution unless you do a backdoor Roth.
So you need the Roth 401k to make a contribution.
Right.
That's right.
Yep. And if you do a backdoor Roth, you're kind of limited by the aggregation rules because they look at what's the total value of your IRAs, and they actually penalize you for doing the backdoor Roth. So you have to be careful with that too.
You have to be really careful, and you don't want to trip on those. So you want to talk to your CFP and your CPA before you make those decisions.
Right. In advance, before you make the decision, not after you've made the decision.
Preferably, right? Yeah.
Hard to undo once it's already been done.
They did. They took away the mulligan on that with one of the recent tax laws. So, it's getting harder and harder to go tax-free.
Yeah. If you're in business, make sure your health insurance premiums are business expense. That's pretty easy to do. Just talk to your CPA or tax person. Income shift, if you can employ your children, rather than, pay the government more money in taxes, you can shift some money over to your kids. You can actually pay them up to $6,000 or $7,000 a year. You may have to incur a little bit of self-employment tax if you're in an S corporation, but you could take that $6,000 or $7,000 and put it into a Roth for them and save it for college education. So there's plenty of ways to shift the income out of your business and make it more to your benefit or your family's benefit.
And small business owners got a target on their backs, and so they ought to be thinking about all the tools they've got in their tool belt to save their taxes.
Right. If you're a cash basis tax filer, which pretty much everybody should be, if they're a small business operator, the traditional play is you look at how the end of the year is looking with your financial statements, and if looks like it's really a great year, something you're not going to see the next year, maybe you want to defer some of that income into next year and accelerate some of those expenses that you have into 2021. You can kind of manage your tax expense doing it that way. And I realize there are certain cases in certain businesses that you just can't defer income into the next year. And I get that, but from so far as the expenses go, hey, do you need to buy a new piece of equipment? Do you want to issue bonuses? Do you want to, buy a new car, a new vehicle, a new truck, some big piece of equipment that you need for the business? You can take accelerated depreciation on those purchases. The only thing I would caution there is depending on what you're acquiring and how you're taking that accelerated depreciation, make sure you understand the difference between bonus depreciation, Section 179 depreciation, and just a regular, what we call maker's depreciation. Because if you have to dispose of that asset at some point in the future, whether you sell it or get rid of it before its useful life, as dictated by the maker's depreciation tables the IRS issued, you could trigger a taxable event on that disposition of that asset. So be sure you understand what you're buying really and how long you want to keep it. That'll help determine which depreciation method you want to use.
Well, and these are great tax ideas, and we're coming up at the end of this year, and some of the clients who we talk to have had really good years, and so it's a common theme that seems appropriate this year just to mention that you should be thinking about accelerating your expenses before the end of the calendar year, and if you're an itemizer at home, if you're doing this for your family, you could even accelerate and possibly make January's mortgage payment in December.
And get an extra kicker for the interest piece. Absolutely. Yep.
Right. Yeah, you save the interest only if you're itemizing.
Right. Correct. Roth conversion.
One of the ideas I threw out there. Yeah, throw out the Roth conversion. We love this, don't we, Mike?
Yep. It's really a powerful tax planning tool if you know two pieces of it, right? If you feel tax rates are going up in the near term, you want to try to take advantage of this as soon as possible, so you're paying the lower tax rates. My 2 cents on that is we just shelled out $9 trillion worth of recovery money. We're going to have to recover that in taxes somehow, and I feel obviously taxes will go up at some point. And we're at pretty low tax rates right now historically. So if you're considering doing a conversion, converting your Roth account into our IRA into a Roth, it'd be the time to talk to Karl about that for sure. If your business is going to have a big loss, I worked with a client last year that had a $180,000 loss, and we turned around and converted $160,000 of his IRA into a Roth. And, put him back into the same.
What a great opportunity that was.
Well, yeah, it's really fun to know if you have losses that you can play with, how to offset that with an IRA rollover to a Roth. So it's kind of pretty powerful. You don't have to do it all in one swoop. You can do it over a period of time. It can be you can do one rollover every year for the next 20 years, right, Karl? I mean, the goal, I guess, would be is to get as much of that IRA rolled over before you have to take a required minimum distribution at age 72. So now you're in control of your money.
Right, a lot.
Yeah.
It's a great planning tool. We love doing it. We have some fantastic calculators that make it visual so that you can play around with it and do it yourself. But you really want to talk to your certified financial planner here to really dive into the details for you, because what you don't want to do, like Mike mentioned, the RMDs, that's a really big one. And a lot of people, as soon as you start at age 72 having to pull money out of your other IRA, not your Roth, you'll pay taxes on that other IRA, and it forces you possibly to pay more taxes than you have to. So the sooner you can get your money into a Roth where there are no required distributions, the less taxes you have over your retirement years.
Right. That's basically the presentation. We're available to help you with any tax planning needs you have, or any questions you have. You can reach out to me or Karl, schedule an appointment, depending on whether you need some financial planning help or some tax help or just bookkeeping or general business advisory. We can help with that.